Well, earlier this week, well-known venture capitalist Ben Horowitz criticized the valuations given to tech companies on secondary markets, saying that, quote, asymmetric information is inflating private share prices. So does this mean that regulators now have to give this a harder look? Well, for more, we're joined by angel investor and managing partner of Tangent Capital Partners, Bob Rice. Bob, good to see you again.
Thank you. Pleasure to be here.
Before we get to the regulatory front of this, I mean, do you believe that shares post and other secondary markets are in fact fueling this, these soaring valuations for these companies?
Well, frankly, there's no question that they are, and it's because there's a huge demand for these kinds of shares, and the companies themselves really don't need to go public and don't really want to go public because, being a public company in this kind of regulatory environment has a lot of real negatives, and they're not like the old school industrial companies that needed massive amounts of capital from the capital markets in order to operate.
In order to start up, essentially.
Right.
Why is there this huge demand? Is it just sort of feeding on itself because you just keep hearing about the Groupons and the Twitters and the Foursquares?
Right, and it's what I call like an intelligent bubble. It is a little bit of a bubble, but the reality is that unlike the bubble in 2000 and 2001, a lot of these companies really are showing very impressive revenue growth. And there's a dearth of attractive IPOs. People are tired of being in the normal public markets, and so they're looking for something new, and they're seeing these revenues go up, and they're thinking, hey, wow, this is a great opportunity.
Well, maybe either they're tired of it or they're not seeing the returns, the same returns,
They're
right?
clearly not seeing the returns right now, and this is really where American innovation is happening, of course, is in these kinds of technology companies, and everybody wants to play, and it's very difficult if the companies aren't going to go public. At the same time, the employees of these companies need liquidity because a lot of their compensation is based on options, of course, so they're the ones who are really driving the market. They're the ones who are putting their shares out for sale. The companies themselves are not, which is why there's a lot of criticism about these, because there's no real information about the companies.
Right.
Because they're not part of the deal. It's just the employees selling to the outsiders.
Who are now going on to these exchanges then. How liquid, by the way, are these exchanges like shares?
They're not liquid. I mean, this is really the problem. They're not liquid. There's asymmetric information. That's very true. And when you put those two things together, you kind of have a recipe for mispricing. And I do think that almost everyone agrees that that's going on.
So you do believe there's mispricing going on. Is there manipulation going on?
There certainly can be, and this is a big risk. I'm not going to say that there is, because I certainly wouldn't know. I don't know of any, but there's it's a kind of market that is subject to being manipulated because a very, very small trade can move an entire market. And, there's no short selling, eh? There's only longs.
That's right.
So there's no short selling to regulate and create a real market here, and it's so thin, and there's so little information, so they just keep going up and up.
So then what should the regulators do? I mean, should they do anything about this?
Well, look, it's a very tough call because, on the one hand, we have to remember that everyone who's buying, or at least in principle everyone who's buying, is at least an accredited investor or a qualified purchaser. And so you're not talking about boiler shops pushing out product to moms and pops, in a way that the SEC needs to rush in.
Right.
I'm concerned about the potential for manipulation. A lot of the VCs are very concerned about this, and the reason is it's inflating prices in a way that they feel is diseconomic, and so they can't invest. So the markets are getting away. The pricing is getting away, and that's one of the reasons that a lot of the VCs are very unhappy about these kinds of developments.
But can't they just ignore it? I mean, they have their own abilities, obviously, to gauge the value of a company, right?
Exactly, and what you'll see is a lot of times the negotiated VC price comes in significantly below the price that you're seeing in these secondary markets. But speaking of the SEC, they're a little bit schizophrenic because they've announced that they're going to look into this, and they should, because there definitely are things that are being done which probably skirt at least the intention of some of the rules. For example, the rule that you have to register with the SEC when you have at least 500 investors. So they get to 499 investors and put a bunch of stock into a new company and sell the shares of that company to keep from going over the limit. There are probably some issues there. But at the same time, the SEC has recently awarded ATS, Alternative Trading System status, to a company in this space.
Okay.
So there's some kind of almost schizophrenia from the regulators.
A conflict there, or a contradiction there then.
Yeah.
Should companies do anything about this at this point?
Well, companies, it's an interesting thing because, again, the companies want to keep their employees happy. The employees need to sell because, again, a big chunk of their compensation is in options in technology startups, right? They're young people. They need to buy houses. They need to pay tuition. So the companies want to make their employees happy. And so typically the companies do have rights of first refusal on these shares. They could stop this if they wanted to in most cases. But they generally go along with it because the employees really want the liquidity.
Interesting. Bob, thank you. Great to see you as always.